Uncle Ron Stuff Money, Part 6. This is an intro to investing. And why an intro? Uh, Investing. Most people start off, if you have excess money at the end of the month, which most people do not, you should think about it, and I've already covered the spending and budgeting and that sort of thing. One of the things that you can add to your column of monthly expenses is you can add an item called savings. And you can pencil in a number from an annual basis. You'd like to save $2,000 this year. In fact, they tell you that the rule of thumb, you should have like 6 months worth of living expenses set aside somewhere in a savings account. Already getting into investing. Banks. There's cash accounts. There's savings accounts. Sometimes the banks will give you some small percent interest as to have a checking account with them. Sometimes they charge you for checking accounts. But they also offer probably savings accounts that you can put money into, and they will pay you some interest on the balance of your savings account. But you can include savings in your monthly expected expenditures and stick money in there. You can make it a separate account someplace, not associated with your checking account. I have a daughter who has like everything she can think of is a separate account. If she's going to buy a new set of furniture, she opens an account and it's totally defined for furniture. And she'll put money in there as it comes in and it's excess. She'll put it in the furniture account, or she puts it in the I need another car account, or she'll put it in somewhere else. And the point being is that's one way to force yourself to save, and you have to have some discipline about it, because otherwise, if you don't do it every month, some months you go buy that new TV, or you get your whatever the whim buying that you wanted. Okay, so you start off, or most people start off just saving money. They have a savings account, pays them a little bit, and then most people learn about what's called certificates of deposit, which you agree to. It's like a savings account, but it has term on it, and they'll say, well, if you'll make sure that we can have $5,000 for 1 year, you won't take any money out of this savings instrument, we'll give you a higher percentage rate in terms of interest. It's called certificate of deposit, and it basically, your money is locked up for whatever term you agree to for that CD. And at one time, that was what most people did. Well, they just bought CDs. They don't call them buy them, but they went to the bank and they bought a CD. And they were guaranteed at the end of the period, be it 1 year, 5 years, they were going to get all their principal back, and typically they get the interest would come at that time. I don't remember, it could be terms where they would credit the interest to some account on a monthly basis, or maybe it's just all provided at the end of the term. I don't remember. But anyway, that would be in the terms and conditions of the CD. That's investing. That's a form of investing. Savings is investing. You know, investing is all kind of things that you can put money into, and the reason you do it is you want whoever it is that whatever you're putting your money, wherever you're putting it, you want, one, to make sure you're going to get all that money back, and two, that it's going to pay you some worthwhile percentage rate, either in interest or dividends or however it's done. You're putting excess money to work. Now you can just keep, And then certain times people take and they take money out of the bank and they shove it in the mattress. They put a tin can in the yard. They bury all the cash. Cash is king. They just hold on to cash. They don't feel safe about the banks. I mean, there was in the 30s and the Great Depression, banks did fail. And that was the reason that the FDIC came into being, Federal Deposit Insurance Corporation. So there is, talking about your principal, say you have $10,000. It's in a bank. You have in the back of your mind that that 10,000 will be there forever and a day. Nothing can happen. Whatever happens, if the bank screwed up and lent way too much money and it all defaulted on that, the bank would go out of business. They're a business. They're not a government entity, but there is what's called Federal Deposit Insurance Corporation, which the bank has to basically buy insurance to cover all their outstanding certificates of deposit, accounts which pay, like savings accounts to pay interest, that sort of thing. That's insured by the government up to so much per account. Now keep that in mind. Only up, I don't know, maybe $100,000. If you have lots and lots and lots and lots of money and you put it in the bank, just keep in mind that only a certain amount of that, and this happened recently with the bank out in California, where some investors, they had like $3 million in one account, but FDIC would only cover 100,000 or whatever it was. They could stand to lose $2.9 million. The bank didn't have it. They had lent it out. They didn't have any money to pay your principal back. Anyway, preservation of principal is the term it's used on investing. You want to keep that in mind. Some investments don't guarantee that. There's a lot of investments that don't guarantee preservation of your principal. Stock is one of them. You buy stock, it's $10 a share. The idea is that you have an idea anyway that that company is going to grow. Their products are great. They're going to expand. They're going to build more factories. They're going to do this and that. They're going to pay off more dividends. They're going to be worth more, because they built factories and they acquired machinery and all this kind of stuff. And 10 years from now, where they were once had a market value of $2 million, now be worth $10 million, and therefore their stock, people would like to own their stock, so the stock price goes up. You bought it for 10, and now it's 30. So that's, but if the company wasn't managed correctly, and I don't care who it is, take Sears and Roebuck for example, J.C. Penney. Those were cellular stocks at one time. They kept expanding. They kept, things looked rosy. They were, Sears and Roebuck. Everybody knew them. J.C. Penney, Walmart, Kmart, all these sorts of things. But when you buy a stock, getting your principal back is not guaranteed. If something bad happen and you're not paying attention, that stock can go in the toilet. Companies literally go bankrupt, and you can't get your money back. Period. Whatever you paid, $10 a share, it's now worthless. Whatever amount of money. Preservation of principal. If you put it in the bank, you're at least covered by the government for $100,000, and they'll guarantee that you get your $100,000 back. Not the interest or anything, but your principal. Uh, Investment. You want to keep the idea in mind, the preservation principle. The more you risk your principal, perhaps more you can get back in the way of return. Maybe. But you realize you're taking a risk, and you could lose money on the whole deal. I had a fellow lived up the street from me, and his wife had always been doing the investment, and she bought CDs, or they had their money all in CDs. Well, the CDs were only paying like 3-4%. And when he retired, he looked at everything and says, geez, that's not going to cut it, I need 10%. He came to me and asked me, what can I invest in that I get 10% on my money? And I said, I don't know anything. I do not. Even the stock market or whatever else, after you pay income taxes and dividends and interest and all those sorts of things off of investments are taxable. After you pay whatever tax bracket you're in, after you pay the federal income tax, the state income tax, and maybe local income tax, you have to look at what your return is after that, and it's hard to get 10. I don't. You read stuff and they'll go, oh yeah, this mutual fund, it's returned 14, 15% annually for the last 20 years. You need to look at carefully at that stuff because they use sliding scales. It's not 100% true. The point being, as he came to me and said, where can I get 10% of my money? He said, I really don't know. I don't know a thing that's legal that you can do. Well, he had some people he knew, and one of the people he knew was what now he learned turned out to be what's called a subprime lender. People who are in various kind of businesses, maybe an independent house builder. You know, he builds houses for people, but they usually pay him a certain way, so he may have to go to the bank and borrow money to get started. He's got to be $40,000 worth of supplies and materials, and he has to hire people. He goes to the bank, and usually those kind of loans are way more expensive than mortgages or car insurance, things like that. It's very speculative. Can he sell the house? Will he even complete the house? So the bank has to charge a higher interest rate. All right, well, some people, their credit is so bad that they cannot go to a bank and get those kind of loans. Well, that market where people who cannot borrow from a bank but can still borrow money is called the subprime market. And in this particular case, he knew somebody that did that. So what he did, he gave 600 grand to this guy who was going to invest it into subprime loans. Various people who were building commercial property or this or that or whatever, all kinds of different stuff, who couldn't get the money from a bank, but they could get it from him, and they were paying him like 15% interest. He was paying his investors 10% and living on the 5% him to handle everything. Okay? And it worked for a long time. He got a monthly check for, he was getting 10% on his money that he had invested for a long time, year in and year out. And then all of a sudden, boom, there was a lawsuit. This guy, there's security regulations on all kinds of investments. Any kind of investment, there's regulation about it. And when it came to this particular situation, this guy had the subprime lender. He had, I don't know, 20 million, 30 million out. He had like 500 investors, individuals that had given him money. He was lending it out to people, subprime lenders who couldn't get money from regular banks or any other source, and charging exorbitant interest rate. Well, it got so large that the securities regulatory people in the government became aware of it, and he wasn't registered as a securities dealer of any kind. He was not known to anybody. He had not been filing paperwork that's required of brokerage houses, other people that buy and sell investments, okay? It was a big giant mess. The point is, the interest payments monthly stopped, and the value of the 600,000 he lent them started going down and down and down. And it took a long time. They had to kick the old guy out and bring in new management. They had to regulators are on their back all the time trying to clean this mess up, and the subprime lender had maybe $3 million invested in some property in Florida that had only been half constructed. So the market to buy that is kind of limited, and even then, he may only get 500 grand out of it when the subprime lender had lent this builder 2 million or something. So the value that he had put in the money, his principal, 600 grand, he put it at risk to get 10% interest on his money. It worked for a while, but then, and the last time I heard, the people who are now running the subprime lender trying to close it up, they had offered him, I think, $75,000 for his shares, if you will, that he had in this enterprise. He put in 600 grand. He had collected some money, 10% a year for 10 years or whatever, but his principal was only worth $75,000. That's an example. The basic principle here is preservation of principle. And sometimes that gets carried to extreme. U.S. Treasury bonds are bought all over the world because we're considered a AAA creditor. We'll always pay our debt. So, whatever the bond's paying, like right now, it's paying 3, 4, 5%, short term and long term. And so institutions and borrowers and people all around the world are buying those things because it's guaranteed interest and preservation of principal. They're going to get their money back. It's not risky in that sense. Although, the United States hasn't defaulted on their debt yet, but, you have to, it's a situation. Anyway, first principle investing is preservation of principle. And the farther you go away from that concept, yes, maybe the higher return on your investment, which is another concept having to do with investing. Return on investment. How much are you getting back? Like if you put it in the bank and you get 3% interest, that's your return on investment, 3%. That does not include the taxes that is going to be owed on that. And Congress likes to yank around that whole how much can be taxed and the rate that it's taxed. They yank and move that around all the time depending on who's in charge politically and the economic status of the federal government. If they're running more and more debt, they might decide they need to raise taxes at everything. And that can severely impact all sorts of investments, even to include the preservation of principal and treasury bonds and bills. Now, if you hold whatever these investments are for the term for which you bought it, you'll get your principal back, unless whoever it was goes belly up and bankrupt. But you've tied up money at a low interest rate, and if you were to try to sell that debt instrument like a bond or a loan you had outstanding somebody, who's going to be willing to buy it at face value? You put $10,000 in it, they'll buy it from you for $8,000 because it's only paying 3% interest. They buy it from you at a discounted value, but you're not getting your total principal back. That's a concept. Return on investment is another important concept about investing. Another important concept is the term. How long are you investing in for? And there is a tendency, everybody, to think they're going to invest long term, but they don't. I had a case not too long ago where there was a fellow I got involved. He had passed away, and he had various investments, and it turned out they were worth a lot of money. And this guy had getting paid a lot over his whole life. So how did he accumulate so much wealth? And the key to that was, like, he owned Coca-Cola and Pepsi-Cola and KFC, I don't know, places like that. But he had bought that stock in 1975, and he had never sold it. And he had set it up so that any dividends that it kicked off were invested in more shares of the same stock. So for 40 years, he had Pepsi Cola and Coca Cola reinvesting their dividends in more Coca Cola and Pepsi Cola. And it grew and it grew and it grew. Now, what happens to most people is they own it for some period of time and the stock goes up $3 and they sell it and a capital gain. I got $3 more than I paid for it. Oh, I'm great. The other, it's not a rule, but you should think long term, especially when it comes to what's called equity investment, and that's another aspect of intro. We've already talked about debt investments. You can lend people money, and they can, you could be a mortgage. You could provide money to one of your children, and they pay it back on a monthly basis. So you're in the mortgage business, and you get interest from them that helps you and helps them. That's certainly possible, but it's a long-term commitment, and the term, uh, the debt you can invest in debt. You can lend people money. You do when you buy a CD. You've lent the money to the bank is going to invest it. Equities are actually owning parts of entities. When you have stock in General Motors or IBM, you actually own a part of that company. That's the way that works. They issued stock to get money from investors so they could build or produce or provide a product. Your own part of that company. That's an equity investment. Another type of investment is gold. Gold is big still around the world. It's considered absolutely safe. I always used to say, I used to have some gold coins that if I went to a foreign country, I would carry at least one of these gold coins because it would almost get you out of jail anywhere in the world. Gold is a universal currency. There are all kind of currencies in the world. U.S. dollar is sort of dominant for various reasons, and that's an interesting story on its own. But gold is considered safe haven. There are other things, the silver, metals. You can invest in metals of all types. You can invest in about anything, and either in terms of a debt instrument or a stock equity type instrument. And you can even invest in what's called gold futures. And this is a type of investment that says, okay, I'm willing to say that a year from now, gold will be worth $20 more an ounce than it is today. You buy what's called futures on that. A year from now, if gold has gone up $30 an ounce, you can sell your contract and get money, big money out of it, because whoever buys that, this is an offer basically to buy gold a year from now for $3 more than a share than it per ounce than it is now. It's basically you agreeing to a contract. You're paying a little amount of money, but at the end of the term of the future, be it 1 year, you either have to buy that gold or you lose your future, the amount of money you put into the future. I didn't explain that very well, but there are all kind of other types of investments. That's one of them, is the future market. There are commodity markets. You can invest in wheat and barley and food stocks. You can pork bellies, all those kind of things. There's lots of places, and people are always out to get your money. And it happens, you've probably seen movies where Joe, his friend came and said, hey, I'm starting a new business. Get in on the ground floor with me. You'll make big money, I guarantee. Or, I got a pony at the race coming up. It's going to win. It's fixed. If you invest, you give me $500, I'm going to put it on that pony. When I win, I'll give you the 500 back plus another 200. All kind of investment schemes. Every day there's another one out there. They, you want to take your hard-earned money, and then they're going to give you something back. And if it sounds too good to be true, it probably is. 10% on your money is hard to get. I'm telling you. It's you may want that, you may need that, but it's hard to get legally. And don't forget the legal side of stuff. Um, uh, you can do whatever you want, but I don't want to get messed up with the IRS. If you do something illegal, for instance, investing, there's various businesses, a cash business, meaning there's really no paper trail of how much income they took in. Well, therefore, when they report to the IRS how much money they earned or what kind of taxes to be paid on, if it's an all-cash business, there can be a tendency for whoever files income tax to maybe not report all that cash receipt they got. So under that condition, yeah, you can make more money, but the IRS is going to catch you eventually. Taxes is a consideration in any investment. You have to consider taxes. So you have to consider, there's debt obligations, there's equities, there's futures, there's commodities, there's metals. There's preservation of principal. How much risk are you willing to take on that principal that you have? How long are you willing to invest something in? Beware of the tendency to be short-term in your thinking on investing money. There's all kind of vehicles that you can use, and we'll talk from IRA to brokerage accounts that sell every kind of investment you can think of. This is all just an introduction to investing, and hopefully you have enough money, you're thinking about it. Again, start off with savings, regular old savings account. Put it on your budget. You need to be saving money enough at least to cover if something happened to your job, you got sick, whatever, you could cover a couple months of expenses. You wouldn't have to use a credit card. You wouldn't have to sell your house. You could pay your debts off with your savings. And that's the first kind of investment you need to do is invest in yourself by saving money. This is on the Ron stuff. This is part 6, I think, of money, and this had to do with the introduction to investing. It's the 6th of November, and it's too long again, but